Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where our focus is on the newly listed firm Raymond Lifestyle. So Raymond as a group has witnessed history in its making. Its demerged lifestyle brand Raymond Lifestyle has now debuted on the stock markets. We have seen that the Raymond Lifestyle has made its stock market debut at 3,020 rupees per share. And this listing marks the latest progress towards the scheme of arrangement that Raymond as a group had announced earlier, in the way with which eventually there will be three separate listed entities along with Raymond Lifestyle that's made its stock debut today, and later on we will also be looking at the real estate arm getting listed. But to talk about Raymond Lifestyle as a whole, what is next for this company as it starts off its the Dalal Street journey as an independent company, let's welcome on the show Mr. Sunil Kataria. He's the CEO of Raymond Lifestyle. Warm welcome to you, sir, and many congratulations on kickstarting this journey. And first up, help us understand, what is the entire vision of Raymond Lifestyle as it ventures out on its own going forward from here? What can viewers expect? You already have some of the shareholders of Raymond which have got automatically 4 shares for every 5 shares held. So they are the automatic shareholders. There are newer listed, there are newer investors who will be starting on to invest in your company starting today. So what is the vision that you would like to share with them?
Yeah. Thank you, Sakshi. Yes, obviously it's a great moment for us, to start an independent journey, and we have just listed the Raymond Lifestyle Limited. This is part of our whole journey of unlocking value and creating shareholder value across Raymond Group. Now, as Raymond Lifestyle Limited sets on its own, it's a pure play lifestyle company which gets to play across with a lot of more independence, a lot of more freedom to chase its own growth path. Now, as we look forward in this company, we are looking at multiple new vectors of growth. The first and foremost that we are aiming at is that our branded apparel business, which has done pretty well over the last 2 years post COVID, we have transformed its EBITDA margins to a double-digit number right now. We are looking at scaling up to roughly around 700-800 stores across 3 brands of Park Avenue, Color Plus, and Raymond Ready to Wear. And through this, we expect a very large reach across India, because we believe we are pretty much, below threshold in terms of access to consumers. And this is something which will help us, along with a lot of marketing, to drive a very, very high double-digit consistent scale up of our branded apparel business. So that's a very one big initiative. We are also looking at launching some very interesting new vectors of growth to make our company truly the complete full men's fashion and lifestyle company. So when we put this vision together, we thought, what are the other areas that we don't have? And then we have identified 3 more new segments of growth. And one of the biggest forays that we have done is Ethnics by Raymond. Now, this is a ready-made ethnic wear vertical that we have created with its own set of stores separately, which is getting rolled out right now. We have put in 120 stores already, and we are looking at tripling these stores over the next 3 years, and this will only strengthen our dominant shareholding in the shares in the wedding space in the country. So we'll give branded fabrics for weddings, which we already do. We will give branded apparels, and then we'll now have ready to wear ethnic wear also available to consumers for the Indian wedding.
Right. So, Mr. Kataria, since you said about 700 to 800 stores and tripling of the current ethnics store as well going forward from here, are you identifying the geographies? How are you identifying? Is it going to be in tier 1, tier 2? Are you also spreading across to tier 3 and tier 4? What is the sense right there that we can understand from you?
Okay, so right now, if you see, we are currently pretty under indexed in the top metros and top tier 1 and tier 2 cities. And this is where a large chunk of the market lies. So our initial focus will be to increase our density across metros, tier 1 and tier 2, and then and parallelly also look at some of the tier 3. We would not maybe right now focus on tier 4, but really the first focus will be across metro to tier 3.
Sir, you've also guided your revenue growth between 12 to 15% going forward up till FY28. You've also guided for doubling your overall EBITDA to 2,000 crores by FY28 as well. We understand, like you said, there are 4 major verticals in which you're present: wedding business, which is your core focus area, the non-wedding branded business, the garmenting business, and the high-value shirting business as well. Going forward, since you're talking about this 12 to 15% growth on the top line, where do you think the maximum contribution will come come in from? How is it spread in terms of revenue mix between these verticals?
So as I said, two large verticals which are going to be very high accelerator growth for us would be branded apparel, and the second would be garmenting business, where, as you know, we have created world-class vertically integrated capability to create suits, jackets, shirts, trousers for the world's best global brands. And that business is also seeing a lot of tailwind from China Plus One, and now hopefully Bangladesh Plus One also will give us a much bigger leverage. We have 12,000 odd people working there which are highly skilled. So between branded apparel and garmenting, we'll see very high double-digit disruptive growths. That is one. These are two verticals. Apart from that, we are also, as I told you, launching three businesses. One is ethnic wear, which I talked of. Then we are looking at a very interesting opportunity in sleepwear, which in fact looking means, as we talk today, we are rolling it out in this month already. Okay. The large part of Indian sleepwear market is by and large unbranded in India, whether it's the Indian traditional sleepwear or whether it's a Western sleepwear. So we have created a new brand called Sleeps by Raymond, which is available at the first of our foray into value pricing, and which is available at an excellent product at sub 1,000 rupee level. And we believe this is a opportunity for us to be the first national brand to disrupt the unbranded sleepwear market of this country and create a huge value out of the upgradation journey of the consumers. So that will be a multiplier for us. Ethnic would be a multiplier for us. And then the third foray that we are doing in a couple of months is getting into innerwear. So between these three businesses, we expect them to be built over the next 3 to 4 years as multiplier businesses. So they will add not percentages of growth, they will add multiples of growth. And then we expect our branded fabric business also to grow at a high single digit. So in that sense, this whole blended piece would give us that overall number that we are talking of.
Okay. And your focus on the wedding portfolio is also huge, sir. Could you tell us, as we move forward in the second half of the fiscal year, which will largely focus on the entire wedding demand, because first half has largely been slower when it comes to the retail as far as the entire sector or the industry is concerned. How are you looking at the demand right there to pick up pace?
See, obviously, we are very bullish about the way the second half is likely to pan out, because in India, there are summer weddings and there is a much larger winter weddings. This time, it's a very off phenomena which happened that India did not see any major weddings in the first half of the year. And we believe there's a backlog which is getting created now. The second half of the year, right up till next 5 months from November, has got almost 45 days of wedding lined up. And plus, a lot of weddings backlog would be there from the first half. So we expect a huge bump up to happen in the second half, led by this large extended wedding season, and we are very well placed there to take advantage, and we expect to really take leverage very strongly of this second half season.
So do talk to us a little bit on the margins overall on the operational level. Where are you at, and which of your segments will largely contribute to your margins going forward from here? Are you also looking at margins to get contributed from your newer businesses that you are talking about, or is it going to be the current focus that is going to largely propel the margins higher?
So right now, if you see the three new businesses, obviously any new business requires an investment for the building a brand, to rolling up, scaling it up. So I think for the next 3 odd years, we see our ethnic wear business, our innerwear and our sleepwear businesses to be invested behind. Having said that, we have pretty good sourcing margins already, gross margins already in our ethnic wear business. So we see the scale up to happen through investments, and a large margin scale up that we have already done today. In the last 4 years, we have moved from 11% to 16% at an overall blended EBITDA margin, which is a pretty substantial journey. We expect our branded fabric business, we expect our apparel business, our garmenting business, and along with structured cost programs to continue to scale up their own margins, and that will help us, also invest behind the new businesses. And as you mentioned, that we are looking at moving up from around 1100 odd crore EBITDA to 2000 crore plus EBITDA in 4 years' time.
Also, sir, you've also mentioned that perhaps your ad spend is likely to go up from here on, to promote some of your newer businesses as well. What is it that what is the cost right now? Where is it headed, and will that add on some pressure on the upside as far as the margins are concerned, at least in the interim?
If you see, even in the last 2 years, we have done store expansion of around 100 odd stores. We have also increased our ad spends across brands even in the last 2 years post-COVID phase. But still, whether it's our fabric business, whether it is garmenting or whether it is apparel business, we have actually transformed the EBITDA margins while doing all this. So post-COVID we have been on a growth phase, but that growth has not come at the cost of EBITDA pressures. In fact, our EBITDA margins in apparel have moved up from post-COVID, when COVID ended in 22, from 4% to 12%, while we have scaled up 100 stores. And this is after doing investments behind ethnics as well. So that tells you the kind of cost programs that we are doing, the kind of scale leverage that we are getting, the kind of sourcing improvement that we are doing, that along with opening stores, along with launching ethnics, we have been able to get our EBITDA margins up so sharply. Same is the story for branded textiles, where EBITDA margins have moved up from pre-COVID 15% levels to 20%. Again, a huge jump on a large base already. So one thing is very clear, we would increase advertising spends. We are doing rollouts, but we have enough leeway internally, and we have enough structured cost program focus that we will not let it impact our margins.
Okay, got it. Sir, how about the pricing strategy currently? Could you also give us a sense of what is the competitive landscape right now, looking at this entire textile space and the lifestyle space that you are in right now? A lot of brands are already present in the men's lifestyle and branded clothing department. So how is the current competitive landscape, and how do you plan to continue to garner more market share than you have right now?
So obviously this is a pretty largish question, because the game to garner share is very different for each of the businesses. So like obviously in the branded textile game, we have very clear strategies to premiumize our suiting business. We have launched, we have options within the shirting business where we have lesser market share to we are tightening and maybe buffering up our mass end of the market to gain market share at the mass end. So these are two large strategies to really gain shares in the branded fabric. Branded apparel, I already talked in detail. It's a mix of product refresh that we have done across 4 brands, the store ramp up that we are doing, plus marketing. I think that's the game out there. Garmenting, we have already talked about that. We are ramping up capacities. We already have huge bank of strategic customers coming our way, and we will keep on acquiring more customers, and that will lead to a very large disruptive growth. And then there are new businesses, where we have already got either a product differentiation or we are building up distribution. So by and large across business we have each respective strategy to grow market shares.
And overall, sir, as I'm given to understand, I think there is a 5% market share in the 750 billion rupees men's wear market that you hold currently. Do you have a vision for that? How is that going to shape up?
So in the large, huge, humongous wedding market of India, which is 75,000 odd crores for the men's apparel wedding market, the large part of it still unbranded, around 92%, and the balance, out of that balance 8% branded, we hold a humongous 5% share. The game is very clearly, with all these initiatives, to take this to around 6.5–7% over the next 4 years.
Okay. So do talk to us about your capex plans going forward. I think you incurred a capex of 100 crore rupees odd in FY24. Where do you see the capacity expansions also take place? Can you also add on any international expansions that you're looking at?
Our capex primarily is geared towards augmenting the capacities in our garmenting business, where we are looking at expanding from around 6.5 million units to around 10 million units. It is already underway, part of which you would have seen in FY24, and the balance would happen over the next 18 months. So that's the journey that we have in terms of a growth capex. Apart from that, we do not see any need for any growth capex. The capex that we are putting together is going to be primarily maintenance capex behind technology, behind automation, but the growth capex is already underway right now. And in terms of stores, we have by and large asset light franchisee model, so we see a very large capex investment going behind store expansion.
Okay, got that. Any fundraise plans that you would have going forward, sir, to service the kind of capex that you're already seeing and you are looking at over the next 4 years?
We are a cash-rich company. We are throwing up every year 500 to 700 crores of free cash flows. Our capex requirements are pretty minimal, as explained. We don't see any need for any fundraise. We are very self-sufficient on this.
Okay, well, on that note, thank you so much, Mr. Kataria. It's been a pleasure to host you and seek all those insights. I wish you all the very best for your journey ahead going forward, and looking forward to speak to you once the quarterly results also come in on Business Today Television. Thank you so much.
Okay, thank you.
All right, viewers, we'll wrap it up at that. This was a special conversation from Raymond's Lifestyle that's made its stock market debut today on the journey going forward, the vision for expansion, the newer product categories that will be launched, the aspiration for a higher market share, and of course the international expansion too. So a whole host of things that will be important for you to track now. Apart from Raymond, you have Raymond Lifestyle, which is the lifestyle brand of Raymond as a group that is now listed separately. We'll continue to track this space even going forward from here.